episode 180, Minimalist Investing.
Welcome to the Frugal Friends podcast, where you'll learn to save money, embrace simplicity, and live a richer life. Here are your hosts, Jen and Jill.
Welcome to the Frugal Friends podcast. My name is Jen.
My name is Jill.
And today we are combining two of our favorite things, minimalism and money, to talk about minimalist investing. How do you feel about it, Jill?
Oh, I feel great about it because we've got some awesome articles that really break it down in a digestible way. This is definitely a fringe topic for me. It's not something I am an expert on, but I think the growth that's present here and the ability to learn more, I think making it accessible to people who might not quite know, how do I invest? How do I go about this? And to attach it to the word minimal sounds attainable and more simple. And yes, if that's what you're thinking, yes, that's what you're about to find here.
Yes. And I think the most popular thing I'm seeing from creators right now are courses about investing, because it is the most difficult thing, I think, about personal finance. Everything else, I mean, besides taxes, but I mean, those get into the weeds when you have a business. But like, I think investing is one of our most complicated subjects, but it doesn't have to be. You don't need a $500 course to learn investing. I have a $100 course. It's actually $77 because I give like discounts out like candy. So if you want one, you want a course on investing, I have one. But the meat of what you really need, we will cover in this episode. And we also have other episodes that kind of introduce the topic. So we have, if you want to queue up some episodes to play next, we have episode 94, which is Retirement 101, where we cover retirement accounts. We have episode 146, which is Understanding the Stock Market with Bola Sokunbi. She has a fantastic book. So if you're looking for a book, I definitely highly recommend hers. And then episode 158, we talk specifically about Roth IRAs with Barbara Ginty. And I think what we're going to talk about today is primarily what goes into your retirement accounts. And so we like to use Roth IRAs. So just keep that in the back of your mind. I will say, neither of us are registered or licensed financial advisors. If you need a personal specific help, like if you're a high income earner or you have some kind of inheritance or high net worth, then you'll definitely want to get some kind of certified financial planner on your side. So that is the disclaimer for this episode, but plenty of people get by with just the information that we're going to share in this episode. But definitely reach out to me if you have any more questions on what we go over.
And similar to every other episode, we talk about what you find on the internet. When you do a first search about this is what you're going to find, and breaking it down even further, giving more perspective and tangible tips on how to implement this with the recognition that, we are not certified financial planners. We don't have all those certificates for investment. I have a license for social work.
I ran the retirement and investing beat at the Penny Hoarder when I worked there. So I've written about investments extensively. Again, wrote a full course on them, but there are plenty of options. If you need like a visual, like video, slides and stuff, cool, take a course. I think if you just are good enough to read, highly recommend Bola Sokunbi's book. And if you just want to listen, if you just need an overview, then buckle up for what we're going to bring you after our sponsors. Today's episode is brought to you by our 7-day no spend challenge. When you are listening to this, hopefully on release day, you will see it as the first day of the month. So hopefully you have your budgets made, but it's also the perfect time to do a no spend challenge, especially if you want to do one for a month. This is kind of like our last month that it's going to be feasible to do one of these, but we highly recommend just start with a week. Start with a 1 week in October, and we've created a free mini workbook that will help you plan, execute, and reflect on a 1-week no-spend challenge so that after 7 days, you know what you need to work on moving forward, and you have an action plan to do so. So if that sounds like something you need, head to frugalfriendspodcast.com/free to get yours.
This is also brought to you by keeping it simple, not complicating things. That's it. Just keeping it simple.
That was a very one line of text.
I kept it simple.
You are fulfilling that. All right. Well, when I Googled minimalist investing, I came out with some pretty good. I think minimalist investing is becoming a buzzword now that minimalism is becoming mainstream. So I loved seeing that. So our first article is actually from a really well-known investing website, Motley Fool, which is fool.com, and it's minimalist investing tips for 2021 and beyond. What do you think of this one, Jill?
I love tips. I love it when they keep it simple. So I think we can just go through all 5 of what they list out.
Absolutely. So the first tip, and so we will go through these kind of tips, and then the second article will be more of the like funds, not specific funds, but like portfolio recommendations, just for educational purposes. Another disclaimer you have to make. You have to make a lot of disclaimers when you're talking about investing. So if you ever see that on social media, I think nobody really cares what influencers say, but we still have to like say it just in case like one person gets mad. So
one person always gets mad, though.
It's always one person gets mad. So we just have to say it to like cover our butts. So the first tip from Motley Fool on this one is hold few funds. So make your investing as simple as possible. And we're going to talk a lot about funds. And so what funds are just mutually funded collections of stocks. The fund is like referencing the money, mutually funded. And it's just like collections of stocks. And typically it's, a collection of all the stocks, that's the most common one you hear. But sometimes it can be like specific, types of stocks like technology or medical companies or just bonds or something. So holding fewer funds doesn't mean you are purchasing single stocks. It can mean the opposite. But holding as few as possible will make your portfolio more manageable, less intimidating, and easier to understand.
The second tip on here is to trade only occasionally. So not only not having a ton of funds everywhere, also engaging with those funds minimally, not constantly tweaking and changing and moving. First of all, it can cost money whenever we do trade those. And also it can make taxes a whole lot more complicated. And so they list here, I'm just going to read off. It's a really helpful explanation here that trading trends can complicate your tax life. And depending on the broker that you're using, it can be quite costly. So one of the simplest ways to reduce taxes and fees is to not trade and let your investments do the long-term work. And that really is what the ultimate purpose of investment is it's a long game. It's not a short game. It's not, I'm going to put in $10 this week and have hundreds of dollars next week. And so when we're constantly in it and moving things, it's complicated. It's not simple. And even the people who really know what they're doing oftentimes aren't even making out on it. They're just intrigued by trading.
Yeah. I would say once or twice a year. If you're a nerd about it, twice a year. If you don't really care about it, but you just know you need to invest, once a year. Pick a date on a January or like a fall day, whatever. Maybe it's October 2nd. Once a year, just to rebalance. That's all. That's the only reason you need to trade. You don't need to trade when the market is doing all these fluctuations, when the news is talking about the market, because the news has always talked about the market. They have like entire sections of newspapers and websites just on the market, entire websites, publications just on the market. So you're always going to find news of it, potentially crashing or going up. So don't use that as your guide for when you rebalance your portfolio. Just pick a day and do it once a year. So, or, twice or 3 times, depending on how you feel about it. So the third, I think, is the most important one on this list. Like, I think you can break all the other ones, but this is the most important one, and it is to auto invest. I've always said that for people working on average incomes or below average incomes, the best way to invest is to invest early and often. And so that means start today and set up auto invest and invest literally every single month until you retire. I don't care how much it is, but never miss a month, even if it's just $10, because once you meet a minimum, Fidelity has a $10 minimum to buy into a fund. ETFs you can do with even less, but I strongly believe that the frequency with which we invest and building up slowly is how average people build wealth. If you're a high income earner, you can afford to max out your Roth IRA, or, probably not a Roth IRA, but your traditional IRA, in one fell swoop, whatever. But not everyone can do that. So if you are somebody who, is finding it hard to max out your retirement accounts, set up an auto invest today and invest every month, no matter how little it is, for the rest of your working life.
I appreciate that you highlighted this one because I would agree. I think it's one of the, again, most attainable, most helpful gifts to our future selves. Again, if everything else feels overwhelming, you're not certain what to do, you're not going to hire somebody, investing has never been on your radar, at least do this. At least contribute to your 401k, at least open a Roth IRA and invest regularly.
Yes.
Again, and I love the permission too that you're highlighting of even if it's $10, hopefully you can do more and do more as you're able, but just get the consistency going.
Yeah, maybe just get that 401k match if you have access to it. I don't care if you're paying off debt, if you're trying to save an emergency fund, if you're saving to redo your kitchen. I don't care what you're doing.
Who are you talking to now? I feel called out.
I'm just saying there's no excuses, just a little bit every month for the rest of your working life.
Beautiful. Number 4 on here is use just one discount broker. You don't have to be all over the place. Just find one, such as Vanguard or Fidelity, Charles Schwab, did I even say that right?
Schwab.
Schwab. It's a tough one. All right.
So cute, Jill. You're so cute.
They all have the capabilities necessary to accommodate the type of investing that, we would do, most listeners would be doing. And so by making a commitment to just one of them, not only can you receive potentially some added benefits once you reach a certain threshold or level, but you can also see your entire portfolio at once in one snapshot. And I think that's a huge component here. We want to talk about ease of accessing these things, knowing what's happening, knowing where our money is, how it's growing. If we've got things all over the place, it's like, where did I put my car keys? Well, how about we just find one place that we generally keep our car keys? And then we always know where our car keys are. That's a silly illustration, but you get the point. So this is, again, if we're talking minimalist investing, simple investing, something that is going to be attainable for us, that will have longevity to it, this is another one of those. Just having one broker, keeping everything there. Most of these places have what you need. You don't need to have 10 different spots.
Yeah. And if you're trying to figure out where do I open my Roth IRA or do I need to move it or something. If you want to have a purely like minimalist portfolio, you definitely, I mean, I would say just open a Roth IRA wherever your 401k is at. And Fidelity is a huge offer of 401ks. It's a great place to also open a Roth IRA. Charles Schwab is great. Vanguard is great. If you don't have a great 401k, then you can use one of those, and you can just use something like Personal Capital, which aggregates all of your accounts in one place. You can see everything in the same place there. We also like M1 if you want a robo-advisor. So what a robo-advisor is, it's just like creates a more complex portfolio for you and auto rebalances it. I don't know if you can choose how often, but typically I think it's quarterly that it rebalances for you. So that if you don't want to have anything to do with any of this, M1 Finance there's no fee. I think that's the main reason that I like it, because a lot of robo-advisors charge a 0.25% fee to manage on top of the fees on the index funds. And that's not huge. But if you can avoid it, why not? And M1 Finance doesn't charge it. So, and if you open a Roth IRA there, you can support the show. Spoiler alert. frugalfriendspodcast.com/M1. But so those are kind of like our favorites, but honestly, having as few accounts as possible is our favorite too. So
that's much freedom in that.
Yeah. And then the last one I thought was really interesting, and this is going to be really cool for all of our FIRE people, like our financial independence enthusiasts, is only access your accounts from a computer. So if you are the type to obsessively check your accounts, it says, I quote, is a futile exercise. Don't do it. Don't look at it. It's not important enough to have on your phone to check at any hour of the day. Like human behavioral economics and behavioral like psychology really encourages us not to do that. Mm-hmm. So only have it on your computer and check it occasionally, and maybe don't even check it when there's like a big like crash going on. Just don't let yourself be tempted by that. So
it's such a good tip.
Yeah.
And I think really helps us to understand how investing works. I think we can see these people who are constantly checking accounts, and it's like, that's not the right way to go about it. It's not how investing actually works. It's not how you're going to see return on your investments is by constantly checking it. A watch pot never boils. All right.
Ah, yes, absolutely. I loved all of these tips, and I think they're all so true. Like from 1 through 5, like you can have a totally balanced one fund portfolio. So there's that. You can get away with checking it once a year and rebalancing it. You can set up auto invest once and never look at it again. You could have one discount broker and do everything from the same place and then only access it from one place. Like, that is how easy it is.
Yeah.
And yeah, I wholeheartedly believe all of these.
I'm putting you on the spot here, but for our listeners who are very new to this concept, when you say check it once a year and rebalance, how are you using that word rebalance?
Well, so that gets into our next article.
Ooh, let's do it.
That's you didn't even know you were segueing, did you?
Oh, no. I know what I'm doing.
Oh, good. Okay. So our next article is called 3 Simple Portfolios, How Investing Like a Minimalist Can Maximize Your Results. And this is from Chris Reining? I'm sorry, Chris.
I'm sorry, Charles Schwab.
Charles Schwab don't care. Chuck don't care. But yeah, so when I say rebalancing, I mean getting your investments back into balance in the ratios that we talk about in these 3 minimalist portfolios. So if you have, like I was saying, like a one fund portfolio, like we're going to talk about, you actually don't need to rebalance it. It rebalances, like whoever runs it rebalances it for you. So like Vanguard or Fidelity, they'll do it for you. And they're not even robo-advisors. So like you don't even need a robo-advisor for that. But if you choose the 2 or 3 fund portfolios, or if you have other funds or stocks you want to dive into, then you only need to rebalance into the ratios that you decide you want. So if you pick one of these and you love it and you want to stick with it, then probably if we have a good year, stocks are going to grow faster than bonds. So by the end of 1 year, where if you wanted 60% stocks and 40% bonds, by the end of the year, you're probably maybe going to be somewhere around 70% stocks and 30% bonds, just because of the disproportionate growth. And so in that case, if you want to stick with that 60-40, you have to rebalance and sell trade some of your stocks for bonds. So that's what that means. You can also not care and just let your stocks keep like going and going. If you are far away from retirement, that's kind of the approach I take. I take a very lazy approach to investing. Not as minimalist, but just lazy. Because we don't plan to retire early. Well, not that early. So we're still pretty far away from retirement. So it's like we can be volatile. We can be aggressive. So we're just, seeing where the market takes us.
We can take risks and be lazy. Mm-hmm. We got time.
Yeah. I mean, you really can be lazy with this. It's fine. So yeah, we'll take a look at 3 different minimalist portfolios. And these are what you put into your, again, primarily Roth IRA. A lot of 401ks will give you these options too. So you can completely put these into your 401k, 403b, 457, whatever, if they're available. Sometimes they won't be, but at least the one fund should be. But Jill, what do you think about this article?
Well, this article just spoke to me off the bat because there's a picture of a van, like camper van, like tiny home living. And I'm like, okay, I could do this. And they're talking about investing. This is great for me.
Yes.
But also, I really appreciated what they had to say in their introduction, even before they talk about the different types of portfolios, just giving some supportive arguments for minimalist investing. And I love this quote that they utilize, which comes from the 12-step program, but take what you want, leave the rest. Mm-hmm. And I think too, this is such a mantra of frugality in all aspects. We love talking about minimalism, simplicity, eco-friendly, eco-sustainability, all of these things. And this is that idea of take what you want, take what you need, but leave the rest. We don't have to be greedy with it all. And similarly with investing, we can go get what you need, get what you want, but don't feel like you've got to do everything that everybody is saying you should be doing. You don't got to be checking it constantly, moving things, having money all over the place. So there's freedom in that.
Absolutely.
I also like what they have to say about financial advisors. And no shade to financial advisors. There's a time and a place and can be really, really helpful. I've enjoyed talking with my financial advisor friends on this. But this concept of we a lot of times can correlate complexity with being better. And that's not always the case. Like sometimes simplicity is better. And a lot of times there is pressure on financial advisors to constantly be tinkering and tweaking with your investments so that you feel as though you're getting your money's worth. And I've actually heard this from some of my financial advisor friends. I mean, obviously they believe in their profession and I think it's a great aim in life. But we were even talking with one of our friends recently who does this for people, like manages others' portfolios. And he's like, I've got one client who wants me to call him the second that there's a dip or a rise in the market, or like just before when I see that the trend is going this direction. And he's just like, who does he think I am? Like, I don't have a magic wand. I don't know. And even then, like, you don't don't want to be reactionary, but that's just it. I think sometimes if we think we've got a financial advisor, we want to see them doing something. They feel the pressure of it. And so we're not actually getting that much return on our investments when we go with a financial advisor. Oftentimes, they've got some really interesting studies listed in this article that have been done. That one was researchers performed a sting operation, which is kind of a funny term to be talking about within the investment world, but it's the term they used in this research.
I love it.
They did a sting operation of sending hundreds of fake clients to actual real financial advisors and found that the advisors were encouraging these clients to chase returns. They recommended strategies that lined their own pockets and pushed expensive active funds. And there's another research project that was done that had similar results to it. So it's just interesting. I think, again, we're all different. Personal finance is personal. For some, it absolutely makes sense, but also know that if you are choosing to do this on your own, simply, minimally, you're not going wrong in that direction either. It is possible to make wise financial investing decisions without paying somebody to help you with that.
Absolutely. I think financial advisors are best for high net worth individuals. They offer a lot of tax loss harvesting and tax benefits and a lot of things that when you have a lot of money, you don't necessarily have time or desire to learn to do yourself. And like, that's when they are really beneficial. And some won't even take you unless you have like 100,000, invested or 500,000. So like there's a reason for that.
If I was a rich girl, la, 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 then I would have a financial advisor.
Don't sing anymore. We'll have to pay for it. So I want to touch on another quote from this article. Oh, it's a smidge different, but it's from Morgan Housel, and he's like our, I don't want to say Kim Kardashian, but he's maybe our Khloe Kardashian in the personal finance world. He's so great. And so this guy actually interviewed him. I don't know who the writer of this is, but like, cool for him. Morgan Housel told him, I'm actually now down to the Vanguard Total Stock Market Index and Berkshire Hathaway. My entire net worth is now literally a checking account, a house, and those two stocks. I don't think it needs to be more complicated than that.
Mic drop. And
Morgan Housel is he is a smart guy in finance. So if he's saying it, I mean, I wouldn't recommend. I don't necessarily desire to have this portfolio. Morgan probably has more money than me, so I don't know. But I thought it was really interesting that somebody that knows so much about personal finance literally just has like one stock, and total stock market index is a fund rather than a stock. But he could have an ETF, which is traded on the stock market. So he could technically have two stocks. But Berkshire Hathaway is Warren Buffett's like holding his thing. And people love Warren Buffett. So, yeah, I thought that was really
eats McDonald's every day.
Yeah, I mean, who doesn't love that? Who doesn't love it? So those are not the portfolios we're going to be talking about in this article, but it is an option. Again, as something that you can like take and leave. And we're not even going to cover ratios in this, but we'll just cover the actual like what's in it. So, yeah, the first one is the one fund portfolio. And this is typically referred to as a target retirement fund. Fidelity calls them freedom funds. But what it is a fund that starts out, you choose it based on like when you think you're going to retire. So I started with a 2055 target date fund. And this is typically the default choice in a 401k plan that offers the fund. So if you opt in and turn it on and you're investing in it, getting the match, and you haven't picked anything, typically if it's run by Fidelity or Vanguard, this is what you're going to be in, is one of these target retirement funds. And that's totally fine. If you don't want to think about rebalancing a portfolio ever, totally fine. It has slightly higher fees than if you were to do a DIY fund, like a 2 or 3. So that's why people who study this stuff tend to promote the 2 and 3 fund portfolio more. But a 1 fund portfolio is totally fine. It's great. It's awesome.
It's something.
I love it. I love it.
Yeah. It's great, and you're doing something.
Like, it's not just like something. It's like a good option.
Yeah.
And it will rebalance, get more conservative the closer you get to that target date that's the fund is named after, which is theoretically your retirement date. If you want something a little more aggressive, you can go out, you can get something like that's, 5 or 10 years after you kind of plan to retire. So it's even customizable in that you're not stuck with one choice. You can pick any of them. But yeah, so it will auto rebalance for you. The reason I'm not in it, A, is because like I study this stuff, and so I like picking and rebalancing, but also because it was a little too conservative for me. I'm a more aggressive investor, so I wanted more stocks and equities than the one fund portfolio offered. But if you're nervous about it, you're a little weary, 1 fund portfolio, great solid choice for beginners. And not beginners, just for anybody.
Right. For anybody.
Yeah.
So the second example and option is the 2 fund portfolio. So the examples given here is through Fidelity. This could look like having a total market index and U.S. bond index. If using Vanguard, this might look like total stock market index, total bond market index. So again, just examples depending on if you're using Fidelity or Vanguard, but that's what a 2 fund portfolio might look like.
Yeah, and the ratios vary based on how, like, what you want. I think typical advice, this is not advice, typical like recommendations have been have your age in bonds. So like I'm 32, so somebody would just say have 32% in bonds and the rest in stocks. So, and that's typically what the 1 fund portfolio will kind of try to do. But that's the one that Morgan Housel was saying, the total stock market index. That's the fund like he's almost entirely in. Most of our portfolio is in the Vanguard total stock market index. This is something that I've seen t-shirts with the VTSAX. All it says is VTSAX. People love, and that's the symbol for the Vanguard Total Stock Market Index Fund.
Stop it.
Yeah, no, I am serious.
Where?
You can't.
Where?
I don't know where they get them. I don't know where they get
where
them.
were you that you saw this?
I was at FinCon. I was at a financial media conference.
Okay.
I mean, but this exists. Like, people love this fund. You don't see the STX or whatever, the bond. I should make that one. We should make that shirt. It's just the bond fund. But yeah, so I want to point out here too is that when you go and look at or when you hear returns, like a lot of people will use 10% as a average return when they're doing math on the stock market, because that's what the S&P 500 has returned over its lifetime, which that was in the 50s. I think the S&P 500 switched and cut out like a number of funds. And I think that since then it's had like an 8%. But since it's never recommended to be 100% in stocks or 100% in equities, I think we can all agree, like, you don't hear anybody recommend that. You're going to have some bonds which like don't return like that at all. Mm-hmm. So I like to use a 7% when I'm doing math because that accounts for inflation. It accounts for, bear and bull markets over time and having bonds, so that's kind of how I do it and why I do it. you can do it however you want.
Hey, it's better to underpromise and overdeliver. Better to be surprised that in time you see 10% return, but anticipate 7.
Yeah. So when I was starting out, I did the 2-fund portfolio. Well, when I was starting out, I did the 1 fund. And then when I hit the minimums for the 2 funds in Vanguard, this was when the minimums were higher. But then I I did a 2-fund portfolio, and I did 90% equities and 10% bonds. So like I'm really aggressive, but I still have some bonds. And so that's like a really common ratio. 60-40 stocks to bonds, also really common. So pick what feels good to you and go with that. And then once a year, rebalance it to get back to whatever feels good to you.
Beautiful.
So that's it. And then buy a shirt that says, VTSAX or something. I don't know.
That's when you're real deep, though.
That's when you're real deep. So once you increase your net worth, we were 2-fund for a long time. And then we actually had a meeting with a financial advisor who recommended we upgrade to a 3-fund portfolio. Ooh. So that's where we mostly are now, plus some like play around funds. But the bulk of our portfolio is still 2-fund, but we have added a total international fund. So international equities, because the US is not the only place where businesses are. There are businesses in China and the UK and Japan. Like,
you mean to tell me people are working around the world?
Right. Do you drive a Toyota or a Hyundai or a Subaru? Like, those are not American. And yeah, I love my Toyotas, even though I don't have a Toyota right now. Yeah. But that's another story. So having some cash in international equities can help just like diversify the portfolio even more. And diversification theoretically protects it from the ups and downs of the American market. So yeah, then you get into the weeds and how you can like divvy up this. I think we were told for us, 15% is good to have there. And they didn't say to change the bond allocation at all. But so yeah, there is, if you are interested in learning more about that, you can just search for Bogleheads, which is probably the same. Those are probably the people
that in, and I won't get a virus on my computer.
Right. Those are probably the people that made the VTSAX shirt. But it's the creator of Vanguard is Jack Bogle, and he has like a fan club, and they religiously promote the 3-fund portfolio. And so those are the minimalist portfolios.
That's it.
Just those. Yeah.
That's it. When everybody's asking you about all these new gadgets and new things, and you can just say, I decided already. This is what I'm going with.
And you know what? I love this last part where he's wrapping up and he's saying 99.999% of investing is doing nothing.
Do you feel validated, Jen?
Yeah, I mean, I didn't feel bad before, but
yes. But you called yourself lazy, and now you can just know you're doing the right thing.
Yeah, I meant that as a compliment. I work more efficiently. So work smarter, not harder. And so this guy says his entire net worth is an S&P 500 index, a handful of stocks, a condo, and a checking account. So this guy also very minimalist. And honestly, like between the S&P 500 and the total stock market index, you won't find a big difference. Don't like overanalyze like, oh, should I be in both? It's not, it doesn't make a big difference. They're both, the total stock market is primarily the S&P 500 companies because they're so big. You know, it just has those smaller companies in there as well. So that's why I like it a little bit more than S&P 500 because I like to have those smaller size companies too. Because why not? They're there. Mm-hmm. You know.
You know what else is here and why not? And
you know,
we
that
love
I just
it.
like to have. Yeah.
The bill of the week.
best minute of your entire week. Maybe a baby was born and his name is William. Maybe you paid off your mortgage. Maybe your car died and you're happy to not have to pay that bill anymore. Duck bills, Buffalo Bills, Bill Clinton. This is the bill of the week.
Hey ladies, this is Peyton from Jacksonville, Florida. I, first of all, love the pod, love that it feels uplifting and inclusive, and it just makes me smile whenever I listen to it. Make something like budgeting and frugality be fun. My bill of the week is that I signed up for a meal kit subscription, and I know that is not normally a very frugal choice, but I work 3 jobs, one full-time, one contract, and then one part-time. And I am also involved in a lot of stuff and running around. And before I signed up, I subsisted on eating spaghetti and I would batch make pancakes, and I felt so gross. But I signed up for the meal kit and they sent it over to my house and I can cook the meals. And it is a bill that I am so happy to pay because it saves me a lot of time and just a lot of mind space that I can put toward other things. And I kind of try to make it frugal. I signed up for one of the cheaper options, even though it does a little bit less of the prep work for me. And I also signed up to get 2 servings in every meal, and I'll have one for dinner and then one for lunch. So I am paying to have dinners and lunches. So love that. Love you guys and hope you're doing good. Bye.
Oh, Peyton, we love a good meal plan or meal kit in busy seasons of life.
Yeah, if you're working 3 jobs and you're on your own and you find that you're just not able to then like value and prioritize food, which is so important to keep you running, because that's what you're doing when you've got 3 jobs. I get it. I support it. And that's what frugality is about, is where are the values, and time is important and valuable too, and what we choose to put that towards. So I love that this is creating some convenience and just giving your body better nutrition.
Yeah, definitely. And you also have to play this game of what is a better use of my time? If I have the emotional, physical, mental capacity to work and make this, this much money every week, but I can get a meal kit versus buying groceries, and so I spend a little bit more here, but I'm still, the inflow of cash is higher doing it this way than it is not working that 3rd job and just trying to save on groceries. So you do the math and you see what is, better and while still being sustainable and not going to burnout. So
we all pay for
that.
convenience. Don't let people hate on you because I know everyone loves to talk about slashing grocery budget, and we talk about that constantly. But like you said, Jen, in busy seasons and recognizing what else you're able to do with your time, it's totally permissible, because while, yes, you're paying for convenience, I do imagine it's not astronomical like sometimes we do imagine, especially when you're repurposing those dinners. It's awesome, Peyton. I'm so glad for you.
Love that.
If you have a bill, whether it's a subscription that you really value, you're glad to be paying for it for what it affords and makes available for your life, or you just know a person named Bill and maybe they're the ones who deliver your meal kit subscription.
Thank you, Bill. Thank you, Bill.
Or anything related to Bill, because we keep it loosey-goosey. Visit frugalfriendspodcast.com/Bill. Leave us a bill. We're excited to hear it.
Loosey-goosey. This bill of the week is brought to you by following us on Instagram. So we are posting more regularly on Instagram. We're sharing tips from the episodes, where to find our lovely guests and the people who write the articles we talk about, and the occasional fun video where we make fun of couponing, but not really, because
Sometimes we hang out late at night and we find things funny and we video record it. And it may or may not make it on Instagram. Sometimes our husbands are like, you guys think that you're more funny than you actually are now.
Finally, we're just like, stop it. Let's let the world decide.
And then the world decides and we cry. But If you are on Instagram and you want to see some visual reinforcement from these episodes, if you just want to see our faces more in the form of short vids and infographics, follow us over at Frugal Friends Podcast. And now it's time for
the lightning round.
Someday, Jen, you got to just scare me with your lightning round.
I don't think I will.
I want to shake in my boots, which are actually my slippers.
I am actually wearing running shoes right now because I have an ankle injury and they're the most padded shoes that I own. Yeah. But anyways, today's lightning round is going to be us sharing our versions of minimalist portfolios. And we do it differently. And we even do it, we love all of the tips from the articles we read, but we even do it differently from that. So again, this is really something you need to make your own. And if somebody is telling you, this is the way to do it my way, there's no other way, or my way beats the market more, don't run from those. Run from everything that those people are saying. So I will go first because in all honesty, I don't have a minimalist portfolio in terms of funds. I have probably fewer funds than most. Not most. I don't know. I have some funds I like to play around with. I have some like ESG funds, which is environment, social governance, like focused funds. I have some medical funds like that are just health related because invest in my values, so I value health. And so I like to, play around with that. I was an acupuncturist for 5 years. So those
we
are
don't talk about that enough. Such a cool background.
But yeah, so that's something I'm interested in. So I invest in it. And environmental sustainability, something I'm passionate about, something I invest in. So I think the key that we try to get across in the short 1 hour time span we have with you each week is to tell you this is just one way to do it. This is the easiest way maybe. But then you graduate from easy. You should graduate from easy. We did the baby steps from Dave Ramsey when we were starting out. Those were easy. And then we learned more and we graduated from them, So this is like the path of least resistance.
Yeah. I'm still working towards graduation, still just like eyeing out that cap and gown. Thanks to this podcast and you, Jen, I actually have a retirement investment account. So
it's
that is
the greatest accomplishment of this entire 3.5 years.
Probably.
Setting you up with a Roth IRA.
And Jen literally did do it
and investing
in her living
it.
room. Mm-hmm.
Yeah.
So that's on auto draft. So really what was it? Tip number 3 from the first article. I'm doing that. And I could not be more pleased for that. And, when we're talking about net worth for us, you're calling me out on it, Jen, but our house is part of that and building up to a point where we can bring in money with our current real estate situation and then invest more. That's what my sights are on next.
Yeah. I just don't want you to ever turn off your auto draft.
Nope.
No matter
not.
how
I'm
bad
increasing
the kitchen gets.
it. I've increased
I love
it
that.
Since you set me up with it.
I love that about you.
Thanks, Jen.
I love that.
I think I love your championing me in it.
I will champion everyone. I want anybody that starts investing from this episode or does something, takes action at all, you DM us at Frugal Friends Podcast. I'm going to celebrate you. Yes. I want to celebrate you.
Yes.
I love it. Yeah, that's probably the most minimalist thing about my portfolio is that I don't look at it often. I trade once a year if I'm lucky. And then, I'm on auto draft. So every month the money comes out and it just does it. And we max out our Roth IRAs, Travis and I each. And that's kind of honestly, the only thing we do right now. We don't even invest in 401ks. And some people are going to be like, well, because I don't have a 401k, I'm self-employed and I haven't set up a solo one. And Travis's 401k options are really bad. So we decided we want to invest in real estate instead.
Beautiful.
So instead of tying up the money, we're still doing $12,000 a year. Mm-hmm. That's nothing to shake your stick at.
Now I got a stick. I'm shaking it.
That's a saying.
Poking them, shaking it.
So yeah, that's how we do it. I don't think any financial expert has a perfect portfolio.
Yeah.
I know them. I know these people, and nobody has the perfect portfolio. You shouldn't have a perfect portfolio.
Because everyone's situation is unique, right? Even though the majority of advice is going to say you should have a Roth IRA and a 401k, well, what happens when both you and your spouse don't have that option available to you? And the 401b doesn't make sense. And is it 403b? What is it?
Yeah.
I'm sorry, 403b.
Yeah, 403b plans are notorious for being horrible, with very high fee annuities. We're getting into the weeds now, but I will say if you have a 403b that's very high fee, 403bwise.org, really great resource, mainly for teachers. I know we have a lot of teachers that listen. So it's a great resource on maybe how it might be possible for you to get in a better type of plan so you still have that tax advantaged option in addition to a Roth IRA. So that's all for this episode. I know it was a lot, but definitely reach out to us on Instagram if you have any questions, comments, concerns. Again, this was for educational purposes only. This is not financial advice. If you want specific advice for your personal situation, then reach out to a certified financial planner, a fiduciary CFP. And now with that disclaimer, please don't sue us. Thank you so much for listening. And thank you for your kind reviews. Thank you for not leaving 1-star reviews if you don't agree with 100% of what we say. Like Ogre Joel, who left a 5-star review and said, I love the accessible, fun way these ladies teach about finance and frugality. I laugh out loud during each episode and have learned so much. A new episode every Friday keeps me motivated and on track with my financial goals. Yes.
Such a great and encouraging review. Thank you, Ogre Joel.
Thank you, Ogre Joel.
We also thank our friends who share these episodes on social media. So when you share the latest episode and tag us on Facebook or Instagram, and like we said, we're hanging out more on Instagram, so hit us up there, tag us there.
So we go and see it. We more likely go to see it now.
We are adding you to our monthly drawing. So the way that works, for every 5 tags and reviews we get each month, we give away a copy of the Frugal Friends workbook. If you've been listening to us long enough, you know that Frugal Friends workbook comes with 2 downloads. So essentially, that's a 2-for-1 reward.
Yes. And this is the last month you'll be able to get the Frugal Friends workbook. I know I said that a few months ago, but I realized we didn't have anything else to give you. But starting next month, we will.
So a new thing.
Yeah, and you can no longer buy the workbook anymore. So that is a thing. This workbook's no longer for sale. So keep leaving us those reviews on iTunes or Stitcher and sending the screenshot to frugalfriendspodcast@gmail.com. Don't forget to tag us on social.
See you next week.
Frugal Friends is produced by Eric Siriani.
I sat next to this guy on a plane once, and he must have paid for the internet on the plane to then be able to constantly look at his stocks and investments. He was just like, and he was like fiendish about it too. I swear he was sweating and his thumbs were going a mile a minute. And at first I thought oh man, he's really being productive on this flight. I'm just queuing up a movie. And then I'm like, actually, he doing too much though.
You can definitely do too much.
Yeah.
You can
And
do too much.
He wanted the people next to him to see what he was doing. Like, he wanted people to be looking over and realizing, oh, yeah, look at him. He's got investment accounts and he must know about them and be keeping track of them.
We got that big stonk energy.
Yeah, I think it was probably honestly Bitcoin that he was trading.
Oh, God.
I got to buy this internet on the plane because there's no time to waste.
I got to keep mining. I got to keep mining. To the moon. Oh, my gosh. Our friend Chris Browning, he said it so eloquently. He's like, investing should be like watching paint dry.
Oh.
That's I mean,
yeah, it
it's
should
great.
not be an exciting endeavor.
No. And I think it's good to have conversations with people that don't agree with you, because there are some people who believe that actively managed mutual funds are superior to passive index funds that you can manage yourself. And it's good to remember that ideology is still out there. And it's not as mainstream anymore. And I haven't met one person in finance that agrees that actively managed, like commission-based money managers that hawk these actively managed funds. Because there are some actively managed funds that are pretty legit. Like if you're super into a certain type of sector, some of those can only be bought actively managed. But I'm talking about like the 5% front load type of funds. Like there are still people that believe that those are superior. And so the work we're doing is good for people. If your financial advisor doesn't take a fee and he makes money on your investments, they may not be promoting the best investments for you. So.
Well, we'll see those people in 30 years and compare notes.
Catch me on Instagram. We'll talk about it.